Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for this subject, Principles and Practices of Accounting. In this lecture, we'll continue with Accounting Chapter 5, that is, Concept and Accounting of Depreciation. We will continue with multiple choice questions in this class. So let us begin. This is lecture number 19 and we are continuing with multiple choice questions. Question number 1. Original cost is 12,60,000. Salvage value is nil. Useful life is 6 years. Depreciation for the first year under sum of digits method will be what? 6 plus 5 plus 4 plus 3 plus 2 plus 1 equals 21. We need to calculate for the first year. So 6 by 21 multiplied by 12,60,000. 6 by 21 multiplied by 12,60,000. Do it on your calculators. Three lakh 60,000. 3,60,000. Answer is A. 3,60,000. Answer is A. 3,60,000. Question 2. Question 2. Obsolescence of a depreciable asset may be caused by obsolescence of a depreciable asset may be caused by A. Technological changes. Okay, first, technological changes. Second, improvement in the production method. Third, change in market demand for the product or service output. Fourth, legal and other restrictions. Options are A. Only first, B. Both first and second, and C. All of the above. 1, 2, 3, 4. That means 1, 2, 3, 4 above. So obsolescence of a depreciable asset may be caused by all the factors which is listed, all the 4 factors. That means answer is C. Answer is C. Due to technological changes, improvement in the production method, change in the market demand for the product and service, and legal and other restrictions. All are the reasons for obsolescence. All are the reasons for obsolescence. Question 3. Question 3. The number of production of similar units expected to be obtained from the use of asset by an enterprise is called as A. Unit life, B. Useful life, C. Production life. The number of production of similar units expected to be obtained from use by an asset by an enterprise is called B. Useful life. B. Useful life. Fourth. Question number 4th. If a concern proposes to discontinue its business from March 2015 and decides to dispose of all its plans within a period of 4 months, the balance sheet as on March 31st, 2015 should indicate the plans at their A. Historical cost, B. Net realizable value NRV, or C. Cost less depreciation. Cost less depreciation. Read the question once again. If a concern proposes to discontinue its business from March 2015 and decides to dispose of all its plans within 4 months, the balance sheet as on March 31st should indicate the plans at their net realizable value. B. Net realizable value. 4B. 4B. Question 5. In the case of downward revaluation of a plant which is for the first time revalued, the account to be debited is A. Plant account, B. Revaluation reserve account, or C. Profit and loss account. In case of downward revaluation of a plant for the first time, so there is no revaluation reserve created earlier, so we will use profit and loss account. Profit and loss account. Question 5, C. Profit and loss account. Next question, question 6. Next question, question 6. The proportion of a acquisition cost of a tangible asset yet to be allocated is known as A. Written down value, B. Accumulated value, C. Realizable value. The proportion of acquisition cost of a tangible asset yet to be allocated is known as A. Written down value. A. Written down value. Question 7. Next question, question 7. The main object of providing depreciation is The main objective of providing depreciation is to A. Create secret reserve, B. Reduce the book value of asset, C. Allocate cost of the asset. The main objective of providing depreciation is to C. Allocate cost of the assets. The objective is not to create secret reserve and reduce the book value of asset. These are not the objectives. The objective for providing depreciation is to allocate cost of the asset. Next question, question 8. Next question, question 8. Original cost of a machine was 25,20,000. Salvage value is 1,20,000. Useful life is 6 years. Annual depreciation under straight line value method would be. Calculate the annual depreciation under straight line method. So original cost is 25 lakhs 20,000 minus 1,20,000 divided by useful life, which is 6 years. It is 4 lakhs. It is 4 lakh. 25 lakh 20,000, that is cost, minus residual value, salvage value 1,20,000 divided by 6 equals 4 lakh. So the answer is B. So the answer is B. Question 8B. Question 9. The cost of machine is 20 lakhs. The cost of machine is 20 lakhs. 2 years later, 2 years later, the book value is 10 lakhs. The straight line percentage of depreciation is, the straight line percentage of depreciation is, if you see, for 2 years, after 2 years, the book value is 50% after 2 years. So per year it is 25%. Per year it is 25%. So 50% depreciation is for 2 years. So for 1 year, the depreciation is 25%. For 1 year, the depreciation is 25%. Question 9C. Question 9C. Question 10. Original cost is 13 lakh. Salvage value is 40,000. Useful life is 6 years. Depreciation under sum of digit method. 6 plus 5 plus 4 plus 3 plus 2 plus 1 equals 21. Depreciation for first year. This, so 6 by 21 multiplied by 13 lakhs. 6 by 21 multiplied by 13 lakhs. Do it on your calculator. Okay, so salvage value is given over here, which is 40,000. Now you do it. 6 by 21 multiplied by 13 lakh minus 40,000. So it's like 6 by 21 multiplied by 12 lakh 60,000 equals 3 lakh 60,000. So it's C. Question 10 C. Question 10 C. Question 11. Which of the following assets does not depreciate? A. Machinery and equipment. B. Patents. C. Land. It's obviously land. Land is a non-depreciable asset. Land is a non-depreciable asset. Question 12. Question 12. A company purchased a machinery on 1st April 2010 for 15 lakhs. It is estimated that the machinery will have a useful life of 5 years. After which it will have no salvage value. The depreciation charged during the year is 15 lakhs minus 0 divided by 5. Cost is 15 lakhs. Salvage value is 0 divided by 5. 3 lakhs. C. Question 12 C. Question 12 C. Question 13. If the equipment account has a balance of 22 lakhs 50,000 and the accumulated depreciation is 14 lakhs, the book value of the equipment is. So equipment account 22 lakh 50,000 minus accumulated depreciation 14 lakhs 14, 22 lakh 50,000 minus 14 lakhs is 8 lakh 50,000. So the answer is B, 8 lakh 50,000. The answer is B, 8 lakh 50,000. I believe you understood till here. The answer is B, 8 lakh 50,000. 13B. Let us shift to the theory questions now. The first question is distinguish between straight line method of depreciation and written down value of method of depreciation. SLM method of depreciation and WDV method of depreciation. Answer. Under straight line method, an equal amount is written off each year throughout the working life of the depreciable asset. So as to reduce the cost of the asset to nil or to its scrap value. To its scrap value at the end under under reducing balance method under reducing balance method a fixed percentage a fixed percentage is charged a fixed percentage is charged on the diminishing balance on the diminishing balance diminishing balance of the asset asset each year each year so as to so as to reduce the value so as to reduce the value of the asset reduce the value of the asset to its scrap value to its scrap value at the end, at the end of the useful life, of the useful life. The basic distinction, the basic distinction between, the basic distinction between, the basic distinction between these two methods, these two methods are as follows, are as follows. Under straight line method, under straight line method, annual depreciation, annual depreciation charge is equal, is equal throughout, throughout, throughout the life of the asset, throughout the life of the asset, but under, but under reducing balance method, under reducing balance method, depreciation, depreciation charge is reduced, is reduced over the years, reduced over the years as as the asset grows old, as the asset grows old. Under, under straight line method, under straight line method, the asset can be, the asset can be fully depreciated, the asset can be fully depreciated, but, but under reducing balance, under reducing balance method, under reducing balance method, asset can never be, never be fully depreciated. Asset can never be fully depreciated. Asset can never be fully depreciated. Under straight line method, under straight line method, the charge for depreciation, the charge for depreciation is constant, is constant, while repair charges, while repair charges increase with, repair charges increase with the life, increase with the life of the asset, life of the asset. So, so the total charge, So the total charge throughout throughout the life of the asset will not be uniform will not be uniform will not be uniform. To the contrary, to the contrary, under under reducing balance under reducing balance method, depreciation under reducing balance method, depreciation charges become high. Depreciation charges become high in the initial years, high in the initial years, but generally, but generally repairs remains low. Repairs remains low. As the asset as the asset grows old, depreciation as the asset grows old, depreciation depreciation charge as the asset grows old, depreciation charge reduces depreciation charge reduces but but repair but repair expenses increase. Repair expenses increase. Thus, under reducing balance method, under reducing balance method, under reducing balance method, depreciation depreciation and repairs depreciation and repairs are more more or less evenly distributed less evenly distributed throughout the life of the asset throughout the life of the asset throughout the life of the asset. I believe you understood this. I believe you understood. Let us see question number 2 now. Write short notes on depletion method of depreciation and sinking fund method. Sinking fund method. Answer 2. Answer 2. First, depletion method of of depreciation. Natural resources include physical assets like physical assets like like mineral deposits, oil and gas, oil and gas resources, and and timber. Depletion per unit, depletion per unit is calculated as depletion per unit is calculated as acquisition acquisition cost less residual value, acquisition cost less residual value divided by estimated life estimated life in terms of production units in terms of production units in terms of production units. I believe you understood this. Sinking fund method. Sinking fund method of depreciation. Sinking fund method of depreciation. Sinking fund method. Sinking fund method of providing. Sinking fund method of providing depreciation is used where where the aim is not only to charge depreciation where the aim is not only to charge depreciation but also to replace the asset in case a large sum in case a large sum of money is required in case a large sum of money is required for the replacement for the replacement of an asset for the replacement of an asset at the end of its effective life at the end of its effective life it may not it may not be advisable it may not be advisable it may not be advisable to leave in the amount of depreciation to leave in the amount of depreciation set apart depreciation set apart annually depreciation set apart annually for it may or may not for it may or may not available in the form of in the form of may or may not available, in the form of concern, in the form of concern itself, the the readily realizable asset, realizable asset, realizable asset at the time it is required, at the time it is required, to safeguard, to safeguard this, to safeguard this position, the amount, the amount, the amount annually provided, amount annually provided for depreciation, the amount annually provided for depreciation may be, may be placed, may be placed to the credit, may be placed to the credit of, to the credit of the sinking fund account, to the credit of the sinking fund account, and at the same time, and at the same time an equivalent amount may be invested in, may be invested in government securities, invested in government securities. The book value, the book value of the book value of the old asset at the time, the book value of the old asset at the time is transferred to the, is transferred to the sinking fund account, sinking fund account, any amount realized, any amount realized, any amount realized on sale of the old asset, sale of the old asset, as well as the profit, the profit or loss, the profit or loss on sale of securities, on sale of securities is transferred, is transferred, is transferred to, is transferred to the sinking fund account, is transferred to the sinking fund account, and it is closed off, and it is closed off by transfer, closed off by transfer of the, by transfer of the balance to the profit and loss account to the profit and loss account or general reserve or general reserve or general reserve. I believe you understood. I believe you understood this sinking fund method of depreciation and depletion method of depreciation. The third question that is asked is what factors are considered for the calculation of depreciation of a plant? What factors are considered for the depreciation of a plant? Answer 3. Answer 3. The the factors considered for for calculation of depreciation are as follows. First factor, cost of asset, cost of asset including expenses, including expenses for installation, including expenses for installation, commissioning, commissioning, trial runs, etc. Trial runs, etc. Second, estimated useful life of the asset, estimated useful life of the asset. Third factor, estimated estimated scrap value, estimated scrap value at the at the end of useful life of the asset, useful life of the asset, at the useful life of the asset. I believe you understood this. So these were the factors to be considered for calculation of depreciation. For calculation of depreciation, the factors to be considered. We are beginning with the practical questions now. We are beginning with the practical questions now. The first practical question. The first question. A firm's plant and machinery account at 31st December 2015 and the corresponding depreciation provision account broken down by year of purchase are as follows. Year of purchase is given over here 1998 to 2014. So 1998 a plant and machinery was purchased at cost for 2 lakh and the depreciation provision is 2 lakh. On 2004 the plant and machinery the cost is 3 lakh and the provision is 3 lakh. 2005 10 lakhs 9 lakh 50,000 is the provision. 2006 plant and machinery at cost 7 lakhs and depreciation provision is 5 lakh 95,000. 2013 the year of purchase plant and machinery at cost 5 lakh and depreciation provision is 75,000. 2014 plant and machinery at cost 3 lakh and depreciation provision is 15 lakhs. The accumulated sum of the plant and machinery at cost is 30 lakhs and The depreciation provision is 21 lakhs 35,000. 21 lakhs 35,000. Depreciation is at a rate of 10% per annum on cost. It is the company's policy to assume that all purchases, sales, and disposal of plant occurred on 30th June in the relevant year for the purchase of calculating depreciation, irrespective of the precise date on which the event occurred. I repeat, it is the company's policy to assume that all purchases, sales, and disposal of plant occurred on 30th June in the relevant year just for the purpose of calculating depreciation, irrespective of the precise date on which these events occurred. During 2015, the following transaction took place. First, purchase of plant and machinery amounted to 15 lakhs. During 2015, plant that had been bought in 2004 was scrapped for 1,70,000. Plant that had been bought for 2005 in 2005 sold for 90,000 was sold for 5,000. So in 2005 purchased for 90,000 and in 2015 the same plant is sold for 5,000. Fourth, plant that had been bought in 2006 for 2,40,000 was sold for 15,000 in 2015. Sold for 15,000 in 2015. You are required to calculate the provision for depreciation of plant and machinery for the year ended 31st December 2015. In calculating this provision, you should bear in mind that it is the company's policy to show any profits or loss on the sale or disposal of plant as a completely separate item in the profit and loss account. I repeat, in calculating this provision, you should bear in mind that it is the company's policy to show any profit or loss on sale and disposal of plant as a completely separate item in the profit and loss account. You are required to prepare the following ledgers during 2015. First, plant and machinery at cost. Second, depreciation provision. And third, sale or disposal of plant and machinery. These three ledgers we have to make in detail. I believe you understood the question well. Kindly refer the question once again. Quickly refer the question once again. Okay, so let us do the solution now. Practical question 1, let us try to solve it. Solution. 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 Calculation of provision for depreciation. Calculation of provision for depreciation of plant and machinery of plant and machinery for the year for the year ended for the year ended 31st December 2015. 31st December 2015. So let's calculate the provision for depreciation. Calculate the provision for depreciation. Date, particulars, amount, and final amount. Plant purchased. Plant purchased in. Plant purchased in 1998. Plant purchased in 1998. 0. Purchased in 2005. It is 0. For 2006. 2006. The total is 7 lakhs, but plant that had been bought in 2006 for 2,40,000 were sold for 15 lakhs. That means what? There are two bifurcations of 7 lakh. One is 2,40,000 and one is 7 lakh minus 2,40,000, that is 4,60,000. So 1 by 2 year at 10% on 2,40,000, 2,40,000, and for the whole year at 10% on 4,60,000. The total is 7 lakh. Over here for the half year it is 12,000. For the whole year it is 46,000 and the total is 58,000. The total is 58,000. The depreciation provision for 2005 it is 50,000. The difference between 10 lakhs and 9 lakh 50,000. So it is 50,000 over here. Stretch these lines. For 2013 it is 5 lakh. So 10% on 5 lakh 50,000. 2014 it is 3 lakhs. So 10% on 3 lakhs. 10% on 3 lakhs it is 30,000. For 2015 purchase of plant and machinery amounted to 15 lakhs, but it would be considered in the mid of the year. 1/2 year at 10% on 15 lakhs, it is 75,000. It is 75,000. Let us do the totals quickly. 50,000 plus 58,000 plus 50,000 plus 30,000 plus 75,000. 2,63,000. 2,63,000. 2,63,000. Next is plant and machinery account. Plant and machinery account for 2015 at cost. For 2015 at cost. To balance brought down 30 lakhs, 30 lakhs, and new purchase is 15 lakhs. So right over here 30 lakhs to purchases, to purchases 15 lakhs, 15 lakhs, total is 45 lakhs, total is 45 lakhs. Out of this, the scrapped is 1,70,000. The scrapped is 1,70,000. By disposal, by disposal account, scrapped 1,70,000. Sold. There are two categories. Sold 90,000 and 2,40,000. 90,000 and 2,40,000. So that is 3,30,000. That is 3,30,000 by balance carried down. 45 lakhs minus 3,30,000 minus 1,70,000. This is 40 lakhs. So this figure is 40 lakhs. 40 lakhs. Next, prepare depreciation provision account. Depreciation provision account for 2015. Provision account for 2015. Particulars, amount, particulars, amount. by balance carried down by balance carried down 21 lakh 35,000 by balance carried down 21 lakh 35,000. We have made some disposals also for 1 lakh 70,000, 90,000, and so these are the disposals that we have made. To disposal account, to disposal account, scrapped, scrapped 1 lakh 70,000, sold 90,000, sold 90,000, sold for 2006 asset 2 lakh 40,000 minus 10% depreciation 24,000, so it is 2 lakh 16,000. It is 2 lakh 16,000. The provision for depreciation for the year end, that is 2 lakh 63,000. We have calculated it 2 lakh 63,000. So right, by profit and loss account, by profit and loss account 2 lakh 63,000, 2 lakh 63,000. Let us do the totals. 2 lakh 63,000 plus 21 lakh 35,000, 23 lakh 98,000, 23 lakh 98,000 minus 1 lakh 70,000 minus 90,000 minus 2 lakh 16,000, 19 lakh 22,000 to balance carried down, closing balance, to balance carried down, this is the closing balance. Let us continue and make sale or disposal, sale or disposal of plant and machinery, sale or disposal of plant and machinery account for 2015, for 2015. Particulars amount, particulars amount. To plant and machinery, particulars amount, particulars amount. To plant and machinery, machinery scrapped, machinery sold, scrapped 1 lakh 70,000, sold 90,000 and 240, that is 330. 90,000, plus 3,30,000 90,000 plus 2,40,000 3,30,000 totals 5 lakhs 5 lakhs by provision for depreciation. Provision for depreciation. There are three provisions for depreciation: 170, 90, and 216. 1,70,000, 90,000, and 2,16,000. 90,000 and 2,16,000. 4,76,000 by cash sales, machinery sold 5,000 and 15,000, 5,000 and 15,000, 5,000 and 15,000, so 20,000 by loss on sale, by loss on sale 5 lakh minus 4,76,000 minus 20,000, it is 4,000. It is 4,000. It is 4,000. I believe you understood till here. I believe you understood till here. Let us continue. Let us continue and understand question number 2. Understand practical question number 2. The machinery account of a factory showed a balance of 19 lakhs on 1st January 2015. Its accounts were made up on 31st December each year, and depreciation is written off at the rate 10% per annum under the diminishing balance method, that is the written down value method. On 1st June 2015, a new machinery was acquired on cost, that is 2,80,000. On 1st June 2015, a new machinery was acquired at a cost of 2,80,000 and installation charges incurred in erecting the machine works out to 8290 on the same date. On 1st June 2015, the machine which had cost rupee 4,37,400 on 1st January 2013 was sold for 75,000. Another machine which had cost 4,37,000 on 1st January 2014 scrapped on the same date and realized nothing. Write plant and machinery account for the year 2015, allowing the same rate of depreciation as in the past, calculating depreciation to the nearest multiple of rupee. Kindly refer the question once again. Kindly refer the question once again. The machinery account of a factory showed a balance of 19 lakhs on 1st January 2015. Its accounts were made up on 31st December 2000 31st December each year, and depreciation is written off at 10% per annum under diminishing balance method. On 1st June 2015, a new machinery was acquired at a cost of 2,80,000 and installation charges are 8,920 on the same date. On 1st June 2015, A machine was had cost 4,37,400. On 1st January 2013, it was sold for 75,000. Another machine which had cost rupee 4,37,000 on 1st January 2014 was scrapped on the same date and realized nothing. We have to make plant and machinery account. We have to make plant and machinery account. Solution 2. Calculation of loss on sale of machine. Loss on sale of machine on 1st June 2015. On 1st June 2015. 1st June 2013. 1st June 2013. Loss on sale of machine 1st June 2013. The cost was 4,37,400. Cost on 1st of January 2013, 4,37,400 less depreciation less depreciation at the rate 10% on 4,37,400, which is 437.40. 43740. 437,400 minus 43740. This would be written down value on 31st of December 2013, which is 393,660. 393,660 less depreciation at the rate 10% on 393,660. 39366. Written down value on 31st December 2014. The written down value is 354,294. 354,294 less depreciation less depreciation at the rate 10% on 3,54,294 for 5 months. For 5 months, January, February, March, April, May, till May. It is 14,762. It is 14,762. 3,39,532. 3,39,532. Sale proceeds, sale proceeds, less sale proceeds. Sale proceed is 75,000. So loss on sale, loss on sale would be 2,64,532. 2,64,532 would be the loss on sale. This is working note number 1. Working note number 1. Working note number 2. Calculation of loss on scrapped machine. Loss on scrapped machine. Machine had cost 4,37,000 on 1st January 2014, was scrapped and realized nothing. And realized nothing. Cost on 1st of January 2014, 4,37,000 less depreciation, at the rate 10% on 4,37,000, 43,700. Written down value on 1st of January 2015, 3,93,300 less depreciation, at the rate 10% on 393300 for 5 months, 16,388, 16,388. Loss on scrap equals 376,912 because it realized nothing. Loss on scrap equals 376,912 because the scrap realized nothing. Next is working note 3. Depreciation. Balance of machinery account on 1st of January 2015, 19 lakhs. 19 lakhs. The machinery account of a factory showed a balance of 19 lakhs. less WDV of machinery sold 354 294 less WDV of machinery scrapped 393 300 WDV of other machinery on 1st of January 2015. Deduct these two figures from 19 lakhs. 11,52,406. 11,52,406. Depreciation at the rate 10% on 11,52,406 for whole year. So for 12 months. 1,15,240. 1,15,240. On 1st June 2015, a new machinery was acquired at a cost of 2,80,000 and installation charges incurred is 8,920. Depreciation at the rate 10% on 288,920 for 7 months. For 7 months, 16,854. 16,854. 1,15,240 plus 16,854 is 1,32,094. 1,32,094. So this is the value of depreciation at last. I believe you understood this. Now let us make plant and machinery account. Let us make plant and machinery account. Date, particulars, amount. Date, particulars, amount. 2015, 1st January to balance brought down 19 lakhs. To balance brought down 19 lakhs. You can refer it from here. The machinery account of a factory showed a balance of 19 lakhs. Then 1st June to bank 2,80,000 plus 8,920. 2,80,000 plus installation and erection 8,920. 1st June 2015. 1st June 2015. 288,920. 1st June there is a sale for 75,000. Buy bank sale 75,000. Buy bank sale 75,000. You can see it from here. Sold for 75,000. Buy depreciation. Buy depreciation on machine sold. On machine that is sold. The depreciation amount is 14,762. 14,762. You can see it from here in the last year for the 5 months 14,762. Loss on sale is 264,532. Loss on sale is 264,532. Loss on scrap is 276,912. So buy loss on sale. Loss on sale. Buy loss on scrap. Loss on scrapping. Of machine. 376,912. 376,912. By depreciation. By depreciation on scrapped machinery. Depreciation on scrapped machinery 16,388. 16,388. By depreciation. By depreciation 1,32,094. 132,094. Let us do the totals. 19 lakhs plus 288,920. 2188,920. 2188,920 minus all these amount minus 75,000 minus 14762 minus 264,532 minus 376,912 deduct 16,388 minus 132094. This amount is 1309232 by balance carried down, by balance carried down, by balance carried down. I believe you understood this. I believe you understood this. Next question. The LG Transport Company purchased 10 trucks for 45 lakhs each on 1st April 2014. On October 1st, 2016, one of the truck is involved in an accident and is completely destroyed, and 27 lakh is received from the insurance in full settlement. On the same date, another truck is purchased by the company for the sum 50 lakhs. The company write off 20% of the original cost per annum. The company observe the calendar year as its financial year. Give the motor truck account for 2 years ending 31st December 2017. You can do this question as homework. Try by your own. Okay, we are stopping here. We are stopping here. Thank you. Thank you.